News. May 7, 2026, Investment Intelligence Briefing. Daily Tech in SaaS Financial News. Daily Tech in SaaS Financial News. News. May 7, 2026, Investment Intelligence Briefing. Executive Summary, Tech Sector Highlights. The technology sector demonstrates accelerating AI-driven transformation with record capital deployment across infrastructure, hardware, and software segments. KKR launched its $10 billion Helix platform targeting AI infrastructure investments, signaling institutional confidence in long-term AI economics. Hyperscalers continue aggressive capital expenditure programs with AWS achieving 28% year-over-year growth acceleration. Memory and storage providers report unprecedented demand driven by AI workloads, while SaaS consolidation reaches 2,698 M&A transactions in 2025. Regulatory scrutiny intensifies with the Apple Epic Supreme Court case and EU enforcement actions, creating headwinds for platform business models. Venture funding maintains momentum with April 2026 recording $56 billion in AI startup investments, though debt maturity concerns emerge with $12.7 billion in SaaS sector loans approaching repayment deadlines. Key financial metrics. Metric. Value. Category. AWS growth, YoY. 28%. Cloud infrastructure. KKR Helix Fund. $10B. AI infrastructure investment. April 2026 VC funding. $56B. Venture capital. SaaS M&A transactions, 2025. 2,698. Market consolidation. SaaS debt maturing. $12.7B. Financial risk. AI infrastructure investment surge. KKR launched Helix, a dedicated $10 billion investment platform focused on AI infrastructure assets including data centers, power generation facilities, and network infrastructure required to support expanding AI compute demands. The initiative reflects institutional investor recognition of AI infrastructure as a distinct asset class with long-term value creation potential. Hyperscaler operators including Amazon Web Services, Microsoft Azure, and Google Cloud Platform continue expanding capital expenditure budgets for GPU clusters, specialized AI accelerators, and supporting power and cooling infrastructure. Industry analysts estimate combined hyperscaler capital expenditure will exceed $200 billion in 2026, representing a 40% increase from 2025 levels. Investment type. Amount. Focus area. KKR Helix platform. $10 billion. Data centers, power generation, network infrastructure. Hyperscaler CapEx 2026. $200+ billion. GPU clusters, AI accelerators, power/cooling. YoY growth rate. 40%. Infrastructure expansion vs 2025. The infrastructure build-out extends beyond traditional data center markets into secondary markets with available power capacity and favorable regulatory environments. Edge computing deployments accelerate as enterprises seek lower latency for real-time AI inference applications. AI hardware and memory market dynamics. Memory and storage providers report exceptional demand driven by AI training and inference workloads requiring high-bandwidth memory configurations. SanDisk parent Western Digital reported record quarterly results with AI-optimized storage solutions showing triple-digit growth rates. Industry supply constraints persist as memory fabrication capacity lags demand growth, creating pricing power for established manufacturers. High-bandwidth memory, HBM, production remains constrained with lead times extending beyond 6 months for advanced HBM3 configurations required by latest GPU platforms. NAND flash pricing stabilized after 2 years of decline as hyperscaler procurement and enterprise AI deployments absorb available capacity. Semiconductor capital equipment orders surge as memory manufacturers accelerate fab expansion plans targeting 2027 to 2028 production increases. Big tech earnings, AI investment vs investor scrutiny. Microsoft, Alphabet, and Meta reported quarterly earnings demonstrating continued revenue growth alongside escalating AI infrastructure investments, drawing increased investor scrutiny regarding return timelines. Microsoft reported Azure revenue growth acceleration to 31% year-over-year, with AI services contributing approximately $10 billion in annualized revenue. Alphabet showcased Google Cloud profitability improvements, reaching 7% operating margin while maintaining aggressive AI model development investments estimated at $12 billion annually. Meta emphasized AI-driven advertising optimization, delivering 27% revenue growth despite Reality Labs recording $4 billion quarterly operating losses. Company. AI revenue/growth metric. Investment/loss metric. Microsoft. Azure growth, 31% YoY. AI services, $10 billion annualized. Infrastructure buildout, near-term margin pressure. Alphabet, Google. Cloud margin, 7%. AI model development, $12 billion annually. Meta. Revenue growth, 27%, AI-driven ads. Reality Labs loss, $4 billion quarterly. Investor questions focus on capital efficiency metrics, competitive moat sustainability, and timeline to positive returns on multi-billion-dollar AI research investments. Management teams emphasized long-term strategic positioning while acknowledging near-term margin pressure from infrastructure build-out and talent acquisition costs. Cloud and SaaS growth acceleration. Amazon Web Services reported 28% revenue growth acceleration, marking the strongest quarterly performance in over 2 years, driven by enterprise AI workload migrations and database modernization initiatives. AWS revenue reached $27.5 billion for the quarter, with operating margin expanding to 38% as economies of scale offset infrastructure investments. Metric. Value. Growth rate. AWS quarterly revenue. $27.50 billion. 28%. AWS operating margin. 38%. Expansion. Enterprise SaaS median growth. 22%. Resilient. Enterprise vendor consolidation. Platform suites. Accelerating. Enterprise SaaS providers demonstrate resilient growth despite macroeconomic uncertainty, with cloud-native solutions achieving median revenue growth rates of 22% across publicly traded companies. Consumption-based pricing models gain adoption as enterprises seek variable cost structures aligned with business performance. Platform consolidation continues as enterprises reduce vendor counts, benefiting integrated suite providers over point solution vendors. Security and compliance capabilities increasingly differentiate competitive positioning as regulatory requirements expand globally. Apple's differentiated AI strategy. Apple reported record quarterly revenue of $111.2 billion, driven by iPhone sales and expanding services segment contribution reaching $23.9 billion. The company articulated a differentiated AI strategy emphasizing on-device processing, privacy preservation, and selective cloud integration, contrasting with competitors' cloud-centric approaches. Revenue performance. Segment. Revenue. Performance. Total revenue. $111.2 billion. Record quarterly performance. Services. $23.9 billion. Plus 14% YoY, 21.5% of total. Wearables and home. Not disclosed. Minus 3% YoY. Apple Intelligence features leverage custom silicon capabilities, enabling advanced AI functionality without cloud dependency for core features, addressing privacy concerns while reducing infrastructure costs. Services revenue growth of 14% year-over-year demonstrates ecosystem monetization effectiveness, with App Store, iCloud, and subscription services driving recurring revenue streams. Strategic AI positioning. Wearables and home segment declined 3%, reflecting market saturation in established product categories. Management emphasized gradual AI feature rollout, prioritizing reliability and user experience over feature velocity, acknowledging potential near-term competitive disadvantages versus more aggressive AI deployment strategies. Venture funding floods AI startups. Venture capital investment in AI-focused startups reached $56 billion in April 2026, establishing a monthly record and representing 68% of total venture funding activity. Notable transactions include PIT raising $16 million for AI-powered business intelligence, Standard Intelligence securing $75 million for enterprise AI platform development, Julia Hub obtaining $65 million for scientific computing AI applications, and Hightouch closing $150 million for customer data platform AI capabilities. The funding landscape demonstrates exceptional investor confidence in AI technologies, with 4 notable transactions spanning from early-stage intelligence platforms to mature customer data applications. Hightouch's $150 million round represents the largest single transaction, reflecting strong demand for AI-powered customer data platforms. Market dynamics and valuation trends. Series A median valuations increased 35% year-over-year, reflecting competitive dynamics for promising AI technologies with defensible differentiation. Early-stage investors prioritize teams with demonstrated AI/ML expertise and access to proprietary datasets, enabling competitive moat development. Metric. Value. AI as percent of total VC activity. 68%. Corporate venture contribution. 28% of AI funding. Series A valuation increase, YoY. 35%. Revenue multiples compressed for later-stage companies as investors emphasize path to profitability over pure growth metrics. Corporate venture arms accelerate investment pace to secure strategic partnerships and technology access, representing 28% of total AI venture funding volume. SaaS industry consolidation accelerates. The SaaS sector recorded 2,698 merger and acquisition transactions in 2025, representing a 23% increase from 2024 levels as private equity firms and strategic acquirers pursue consolidation opportunities. Thoma Bravo emerged as the most active financial buyer, completing 47 SaaS acquisitions totaling $18.6 billion in transaction value, focusing on profitable vertical SaaS and enterprise infrastructure software assets. Vista Equity Partners maintained similar activity levels with 41 transactions, emphasizing founder-led companies achieving strong unit economics. Strategic acquirers prioritize platform expansion through tuck-in acquisitions, adding adjacent capabilities or vertical market expertise. Purchase price multiples compressed to median 6.2x forward revenue for profitable SaaS companies from peak levels of 12.5x in 2021. Creating attractive entry points for well-capitalized buyers. Take-private transactions accelerated as public market valuations declined below private market clearing prices, with 23 SaaS companies completing going private transactions in 2025. Acquirer type. Transaction count. Total value. Median multiple. Private equity. 1,347. $124.6b. 6.2x. Strategic, Tech. 892. $86.4b. 7.1x. Strategic, Non-Tech. 459. $42.8b. 5.8x. SaaS sector debt maturity risks. The SaaS sector faces $12.7 billion in term loan and credit facility maturities over the next 18 months, creating refinancing pressure amid elevated interest rates and tightened lending standards. Approximately 340 private SaaS companies hold outstanding debt requiring refinancing or repayment, with 68% of borrowers demonstrating negative cash flow in trailing 12 months. Metric. Value. Total debt maturing, 18 months. $12.70 billion. Companies requiring refinancing. 340. Borrowers with negative cash flow. 68%. Projected distressed transactions. 15-20%. Lenders impose stricter covenant requirements including minimum revenue growth thresholds and adjusted EBITDA margins for refinancing transactions. Alternative financing solutions gain adoption including revenue-based financing structures and accounts receivable securitization programs providing liquidity without equity dilution. Embedded finance capabilities emerge as strategic revenue diversification opportunity with SaaS platforms integrating payment processing, lending, and treasury management services capturing additional revenue streams while improving customer retention. Analysts project 15 to 20% of debt-burdened SaaS companies may pursue distressed M&A transactions or structured workouts if refinancing markets remain constrained. Regulatory battles intensify for tech giants. Technology platforms face expanding regulatory scrutiny across antitrust, content moderation, and platform governance domains with material financial and strategic implications. The Apple Epic Games Supreme Court case reaches final arguments determining whether platform operators can mandate exclusive payment processing, with potential revenue impact of $8 to $12 billion annually for Apple's services segment if unfavorable ruling requires third-party payment option availability. European Union enforcement actions target Meta, Google, and Amazon under Digital Markets Act provisions requiring interoperability, data portability, and reduced self-preferencing in platform services. Proposed penalties reach 10% of global revenue for non-compliance, creating potential liabilities exceeding $20 billion for repeat violations. U.S. congressional committees advance multiple antitrust reform bills restricting platform acquisitions, mandating API access, and prohibiting preferential treatment of first-party services. Compliance costs escalate as platforms implement regional content moderation teams, legal review processes, and technical infrastructure supporting regulatory requirements across multiple jurisdictions. Company. Regulatory issue. Jurisdiction. Potential impact. Apple. App Store payment processing mandate, Epic Games case. U.S. Supreme Court. $8 to $12 billion annual revenue exposure in services segment. Meta. Interoperability and data portability requirements. EU, Digital Markets Act. Up to 10% global revenue penalties, $20 plus for repeat violations. Google. Self-preferencing restrictions in platform services. EU, Digital Markets Act. Up to 10% global revenue penalties for non-compliance. Amazon. Platform governance and reduced self-preferencing. EU, Digital Markets Act. Compliance infrastructure costs and operational constraints. Multiple platforms. Antitrust reform bills, acquisition restrictions, API access mandates. U.S. Congress. Increased compliance costs, content moderation teams, legal review processes. User safety vs. growth, platform challenges. Roblox Corporation reduced full-year revenue guidance by $250 million citing implementation of enhanced user safety measures restricting certain engagement features and content discovery mechanisms following regulatory pressure and public scrutiny of child safety practices. The guidance revision demonstrates inherent tension between platform growth optimization and user protection requirements, particularly for platforms serving minor demographics. Impact category. Value. Revenue guidance reduction. $250 Safety measure operating expense increase. $180 million annually. Daily active user engagement decline. 6-8%. Enhanced content moderation systems utilizing AI screening and human review increased operating expenses by approximately $180 million annually while reducing daily active user engagement metrics by 6-8%. Investor reactions reflected concerns regarding scalability of safety-focused business models and potential regulatory expansion to additional platform categories. Industry analysts project similar safety infrastructure investments required across social media, gaming, and user-generated content platforms over 24 to 36 months. Platform operators explore age verification technologies, parental control enhancements, and algorithmic transparency measures balancing safety improvements with user experience and growth objectives. Market outlook and investment implications. The technology sector enters a transitional phase characterized by substantial AI infrastructure investment, evolving regulatory frameworks, and business model adaptation across enterprise and consumer segments. Investment professionals should monitor capital allocation efficiency metrics as AI spending approaches $200 billion annually across hyperscalers, evaluating competitive differentiation, sustainability, and return timeline clarity. SaaS consolidation creates opportunities in profitable vertical software and infrastructure categories with strong unit economics, particularly as valuation multiples compress to 6.2x forward revenue from peak levels. Debt maturity concentrations warrant credit analysis focus on SaaS borrowers with negative cash flow profiles facing refinancing challenges in constrained lending environments. Regulatory developments introduce execution risk for platform business models dependent on exclusive ecosystems and data monetization, requiring scenario analysis for revenue impact ranging from 5 to 15% under adverse regulatory outcomes. Venture portfolio construction should emphasize AI startups with proprietary datasets, demonstrated enterprise traction, and clear paths to positive unit economics as later-stage valuation multiples compress. The embedded finance opportunity within SaaS platforms represents attractive revenue diversification with higher margin payment and lending revenue streams complementing core software subscription models.